Sensex at 74,000, Nifty at 22,500. Is it the start of a bull run? Should I be booking profits at these levels? Should I change my asset allocation in favor of equities? But my friends also tell me that the markets may crash. Should I invest money which I have for 1 year in equities as we may have an election rally? Good afternoon, ladies and gentlemen. We live in a time where information is in excess, but actionable information is in scarcity. It's in times like these which make an investor worry about the impending correction while others worry about FOMO. To discuss our topic for the day, markets at an all-time high, do's and don'ts, we have with us Mr. Ajay Tyagi. Mr. Tyagi is the head of equities at UTI Asset Management Company. He's a CFA charter holder from the CFA Institute, USA. He joined UTI Asset Management Company in 2000 and has won many awards and accolades for his performance both globally and domestically. Thank you, sir, for taking out time for us today.
Yeah, thank you, Megha and Harsh, for calling me on this podcast.
So, my first question to you is on the indices itself. Most Indian investors typically track Nifty or Sensex, and they typically try to gauge the market by the number which these indices trade. Many times, we have also seen investors make decisions about their mid cap and small cap holdings basis the indices levels of Nifty and Sensex. So, as a professional investor, I would like to understand from you how much importance do you give to these numbers, if at all, and what could be the pros and cons of just tracking these two numbers?
Sure. I think that's a very good question to start this conversation. I would say the salience of the Nifty 50 and BSE Sensex is basically to figure out the temperature of the market. I mean, in India or outside of India, there are always a few indices which the markets at large would refer to. So in the US, you would refer to either Dow Jones or S&P 500. For anybody investing into tech, NASDAQ is important. In India, people typically would refer to the Sensex or Nifty. Some may refer to the Nifty mid-cap index if they are specifically talking about mid-cap. So I would say it is still important to measure the temperature of the market, to figure out whether the markets are overheated or they are cheap or they are just consolidating. But I guess the intent of your question is to figure out, should one only be looking at these two indices as the barometer of the overall economy, or one needs to actually dig deeper? And I think here is where I would say that these two indices are important to gain a 30,000 feet view. But if you really must try and figure out what's happening in the economy, what's happening in various parts of the economy as represented by different segments of the market, then you have to dig deeper. For instance, let me just take today's example. If you limit yourself to the Nifty 50 or the Sensex, you may actually come to a conclusion that the markets are not too expensive. They're slightly expensive, but they're not too expensive. But if you were to actually look at the Nifty mid-cap index or the small cap index, the conclusion can be very, very different. Indeed, the conclusion has to be that the markets are, or rather, I should say, this particular segment of the market, by which I mean mid and small caps, are terribly expensive, possibly the most expensive ever over a 20-year period. So that's why I say, the big indices, the more popular indices, give you a good 30,000 feet view, but that's only one part of the story. You must dig deeper to actually gain more insights about what's happening in different parts of the market. Yeah.
Thank you for setting that context, and which takes me to my next question, which is that India is a growing country, and it is only natural that every few years the markets are going to touch all-time highs. Now, we often come across investors, as practitioners, wherein they probably want to take some profits off the table, but many a times they are not very sure as to what to do with it. Relative attractiveness or other asset classes are often ignored while making a selling decision. So I would like to understand from you that how much time and energy should an investor devote to reinvestment opportunities before selling something?
Correct. In in my conversation, you may actually repeatedly hear from me the importance of asset allocation plan, and I think both you and Harsh know it better than me because you are always facing the client while we are managing money on this side. That the single most important decision one must take is asset allocation, and that's actually on a scale of 10. I would say it's decision number 1 to 7. Decision number 8, 9, and 10 could be about within the asset allocation plan, what percentage should be a particular fund or B particular fund, and so on. So I would say a lot of problems get resolved if you have the asset allocation plan right, and that's where I would say the importance of a financial advisor is there. And so basically, let me keep the asset allocation plan as an integral part and then respond to multiple of your questions. In this question itself, if you see, the the terrible mistake that many people make when they see that the markets have risen, therefore their own investments have given them a very strong return, much higher than what they would have anticipated, they typically feel the itch to actually sell and come out. Now, there are two pitfalls to this. One, their asset allocation plan requires them to stay invested patiently into equities, whether markets are going up or going down. They are disregarding this when they are, pulling the trigger and booking profits. But the bigger problem is, you see, there is enough number of research that has been done over the last 50 years, which tells you that, look, if you miss out on the best 5 days in the market or the best 10 days in the market, then your IRRs fall significantly. The rate of return that you get from your investments may fall significantly. And markets being as unpredictable as anything else, you and I can never know whether the few best days would happen when I am invested or would happen when I exit. I think that's the most important point that you and I have to understand. Rebalancing the portfolio as per what the asset allocation plan warrants is something which must be done. Booking profits, exiting out of equity markets because you've made enough money does not make any sense. And I say this on either side. Sometimes investors exit because they're too frustrated because the markets have gone nowhere over the past 3 years. Therefore, they haven't made money, and therefore this itch to exit. On the other hand, sometimes people get too satisfied by making 30-40% return in a single year, and therefore they want to exit. I think both things don't make any sense. And what makes sense is to keep rebalancing your portfolio. If the asset allocation is 50% in equities, and because of mark to market gains, your equity portfolio has gone to 60%, you should only divest to the extent of 10% of your overall portfolio and let the remaining stay invested. Yeah.
We cannot stress enough on, how irrelevant timing the market is. And so this brings me to my next question, which is, the issue of overconfidence. Now, and it becomes more dominant in times like these when for last 8 years in a 30-year period, the markets have demonstrated very low volatility. Unfortunately, this also, raises complacency in most investors and advisors alike. Now, we also understand that, when you have such long periods of low volatility, sporadic volatile movements are very likely. So, how should an investor probably embrace himself or train his or her mind enough to embrace the transition period?
So, volatility is always the highest when markets are actually, either making either, I can't say a new low, but when markets are actually sliding down like a knife, or when markets are making a new high. So at the extremes, volatility is always the highest. And usually volatility dies down when markets are consolidating, therefore volumes have become very low, the attractiveness of the market is gone, and so on. So I would say that at this stage, at least most of the screens that we look at are telling us that markets are expensive. In certain quarters of the market, in certain segments, markets are terribly expensive. I don't want to mince words, Megha, but without being economical with words, I just want to tell you that certain parts of the market are red hot. And, if we do the charts are not giving us a pleasing picture because they're telling us that they are hotter than what they were in Jan 2008. which was pretty much a massive bull run which lasted 3-4 years, ended in the financial crisis, and we saw massive decline in stock prices. So I'm not suggesting whether we'll get into a massive decline in stock prices right now. So that's not the intent of making the statement, but the intent of making the statement certainly is that we are talking about valuations being elevated in certain segments. Therefore, brace for volatility. If you are one of those investors, who are following your asset allocation plan assiduously, you don't need to worry, except that there would be volatility. As of now, like I said, if certain part of your portfolio has gone higher than what the allocation plan suggests or warrants, please bring it down. Stay put at the intended allocation. If markets crack 10-20%, good for you. You would have time to rebalance on the other side then. But given the juncture at which the markets are today, I will not be surprised if some hard volatility hits us on our face in the coming months. Yeah.
Very interesting, sir. And from valuations, we come down to the types of investor. Now, with technology progressing, first it was search engines. Now we are getting into Gen AI. We see a lot of DIY investors, and we have seen that category exploding in last 3 to 4 years. Now, I'm not getting into the merit of DIY versus advisor-led investments, but my question is for those investors who do it on their own, what are the key macros and micros which they should research vigorously before making their buying or selling decisions?
Harsh, I think that's a very pertinent question because we see the growing herd of people who feel that money making is easy. Money making has been easy for them because these crop of investors haven't seen a down year, let alone a painful market. There hasn't been a big down year since 2014, by the way. 2020, the pandemic was a terrible few months, but the markets pretty much recovered by the end of the year. And I think that's giving the huge amount of overconfidence to a lot of these investors who feel that investing can be a full day job, and people can sit in front of their screens, construct their own portfolios, make money. Uh, Again, history tells us this is never easy. There is a toolkit that is required if you really must be an investor. And I'm not suggesting that being an investor requires certain extraordinary skills or having a very high IQ. It does require a huge amount of discipline. It does require a huge amount of deep research and therefore commitment of time. So I think that is point number one, which any investor who wants to do it himself or herself should be conscious of. Number two, you see, there are no shortcuts here, Harsh. You have to actually dig deeper into everything. Now, there are investors like me who don't pay too much heed to the macros because the style that I follow is a bottom-up style. So I pay a lot of attention to the micros. They can be investors who do a top-down investing, pay a lot of attention to macros, and then formulate the portfolio. Both approaches, a top-down approach or a bottom-up approach, requires a very different kind of research. If I talk about what's the micro-driven research, then all you have to do is go deep into the subject to figure out what is it that would lead to the industry, first of all, doing well. What are the factors which will add to the tailwinds? What are the factors which can suddenly surprise you? See, in investments, one of the most important things is trying to anticipate where would the curveball come from. I know it's difficult to figure out where the bullet is going to be fired from, but if you really must have a successful portfolio which can withstand the volatility in the market, then you must be able to also figure out where can your hypothesis go wrong. So you should have the ability to punch holes in your own story. If you are very positive about the defense sector in India, then you must also be able to visualize what can be the hurdles, where can one trip despite the best execution by companies. Where can growth get hurt, or maybe profitability get hurt. So essentially you have to visualize things like a business owner. You have to do a very deep dive into maybe what we traditionally call as the SWOT analysis of each business. And then, last but not the least, you have to look into the eye of the people who are running this business to really gain comfort in terms of what do they intend to do and what are their execution plans. Look, artificial intelligence is all fine. Let me tell you one thing, and at least I feel so. Whether I'll be proven right or wrong, I don't know. But what I feel is that all of these tools, whether it's artificial intelligence or any other analytical tools that you may use, are important in separating the wheat from the chaff. But in the end, zeroing in on businesses which will create that wealth for you needs to be done only when you have met people face to face in blood and flesh. And like I said, you've looked into the eye of the people who are managing this to gain your conviction. This is irreplaceable for somebody who feels that they can only just punch in numbers, look at the output, then take a call. I think there's going to be disappointment down the road. I'm not undermining the importance of analytical tools. I'm not undermining the importance of quantitative screening, but in the final analysis, it has to be more qualitative than remaining purely quantitative.
Absolutely, sir. And we do agree to that because whenever we do our fund analysis, numbers is one part of it, but we interact with fund managers and we try to have these podcasts so that a qualitative element is also visible to the end user investors as well as us. Now, so we wanted to keep this podcast for 5 questions only, and this is my last question, and I would try to be a little more broader in terms of asking my doubts. Now, this time is different. Now, this is a term or these four-letter word we keep on hearing when we are in a bull run or in a bear run, which extends a little longer. At this point of time, we are hearing this term for quite some time now. Now, on one hand, I'm not questioning the hypothesis that structurally India is looking good. We do agree to most of the macro fundamentals which are playing out at this point of time. But let me try to be devil's advocate at this point and try to ask from you, are we over marketing ourselves to the world around us? Are we being overly bullish about us? Or is there a reason to believe that this time is actually different for India?
I think, Harsh, this is the best question that we've had on this podcast. And this is a question that at UTI, I and all my colleagues are trying to answer every day, because the market is telling you something different. When you look at data, when you speak to companies, when you speak to businesses, they are telling you something very different. Of course, the slowdown that we are seeing in the consumption side is also a data point that has to be considered. And this is a fairly wide set of companies, starting from paint companies to FMCG companies to QSRs. We've seen very weak data coming in from the likes of Jubilant or for that matter, Westlife, which is basically running the McDonald's stores in India and so on. So we've seen very weak data coming from building material companies, whether it be tiles companies or ceramic and faucets companies and so on. So on one hand, you have this bottom up data that we are looking at every day. On the other hand, you have this huge narrative that's there in the market about how India can never go wrong and so on. I'll come to India in a bit. Let me tell you that we still remain very positive about India's story. But let me tell you, since you started the question with this time, it's different. Let me narrate a story to you. And this is the time when I joined UTI. Exactly 24 years back. So the US government has to give what is known as the State of the Union address. And that time, when I had just joined in 2000, the State of the Union address was being given by Bill Clinton. And Bill Clinton was actually in that address was making a statement that the health of the US markets has not been better ever in the last 30 years. By the way, that was a statement of fact, so he wasn't making it up. He was factually right. Post the 70s, the massive spurt in inflation that we saw in 70s, and also high crude prices and therefore demand falling off. Over the next 25 to 30 years, demand was never as robust as between 90, and obviously markets were at the peak. This was later, this phase later was the bubble did burst. By the way, the bubble started bursting when the health of the US economy was the best, was, as they say, US was in the pink of health when all of this started to happen. Likewise for Japan, many of you know the Japanese story. Japan was a wonderful market from 70s right through the 80s. They say that the Imperial Palace in Tokyo was more expensive than all of the real estate in California put together. Such was the amount of fraud that had got built in. Of course, India is nowhere close to those valuations which Japan was witnessing. But the fact is that they too were in their pink of health, their economy was doing well, and therefore everybody just wanted to, participate in their stock markets, and they were dead out for 30 years. Look, when we come back to India, we have to be aware about all of these episodes in the past. Let's be specific on India now. What's our valuation? I cannot call it a bubble valuation, but it certainly is a valuation which we have not reached in the past over the last 25, 30 years. Here I'm talking about both the large caps and also the mid and small caps. Of course, in case of large caps, we are just about 20 to 25% overvalued. So, I mean, I'm not very concerned or bothered about it. But in case of mid and small caps, we are about 40 to 50% overvalued. We are, as a team at UTI, concerned about these valuations. There is a certain pocket of the market, the PSUs, which has gone berserk, and the valuations are, reaching to a level where the execution of these businesses is expected to be better than their private sector counterparts, something which we can't rationalize because we are not seeing on the ground the ability of these businesses to effect and execute business plans better than their private sector counterparts. So there, here too, we have a huge amount of expectations built in. Now, if you put all of this together, our analysis is that India will continue to grow and grow at a healthy clip. I'm not saying we'll necessarily grow at 7% plus, but even if we grow somewhere around 6%, that's a major accomplishment because at $4 trillion, almost at $4 trillion, growing at 6% itself is a very, very difficult ask. But the beauty is when we look at things bottom up, penetration of cars in India, penetration of two-wheelers in India, penetration of homes in India, of air conditioners in India. When we look at many of these data points, we realize that, look, we've barely scratched our surface. The most important data point is per capita income of 2,300, market average is almost $10,000. So obviously we won't get into a middle income trap. We won't get into a growth air pocket anytime soon, hopefully not in the next decade or more. But are the valuations telling us something else? And this is where the worrying part is. I think the valuations are telling us that, look, growth will go on unabated at a very healthy clip year after year. That never happens. That hasn't happened in the cradle of capitalism, which is the US market. They too, despite the best of companies and productivity levels being many times higher than India, they too have gone through their own cycles of booms and busts, and therefore economic expansion and contraction, and therefore earnings growth as well as earnings decline. I suspect that if we put all of this together, we could see a phase of consolidation in India. We could even see a phase of a 10 to 15% correction in India. It's very difficult to call out any of these things. But I'll end by saying we remain positive medium to long term on the prospects of the Indian economy and therefore the Indian markets. We are not too sure about how the markets per se would behave over the next 6 to 12 months period. Our inner voice tells us that markets are in for high volatility and maybe a phase of consolidation and correction. Yeah.
Understood, sir. So short term, not sure. Medium to long term, bullish on India. And so with this, we come to the end of our conversation and a lot of key takeaways for us and for our investors. I'll just try to jot down a few of them. Popular indices give you 30,000 feet view, but not the entire picture. If you miss best 5 or 10 days in the market, the portfolio return over a longer period of time also can take a significant hit. Stay put at intended allocation and don't worry too much about valuation if your asset allocation is on track. One should have the ability to punch holes within one's own hypothesis. AI tools are helpful, but a detailed analysis can only be done once you do primary research, once you meet the management, once you do qualitative analysis. And lastly, growth can't keep on going unabated for years. It's all cycles at the end of the day, and good cycles lead to bad cycles and vice versa. With this, we end our conversation. Thank you so much for taking out time and explaining us the nuances of market when market is touching lifetime high. Thank you.
Lovely. Nice talking to you, Harsh and Megha, as always. Thank you.